One of the key features of Biden's Inflation Reduction Act, IRA, is the consumer tax credits for electric vehicles and batteries that are made in the U.S. These tax credits are meant to encourage more Americans to switch to cleaner and greener transportation options, as well as to boost domestic manufacturing and innovation in the electric vehicle industry. The IRA offers a base tax credit of $7,500 for new electric vehicles and $4,000 for used electric vehicles. However, these amounts can vary depending on several factors, such as the income level of the buyer, the location of the vehicle assembly, the origin of the battery materials, and the price of the vehicle. For example, only singles with incomes up to $150,000 and couples with incomes up to $300,000 can qualify for the tax credits. This income cap is designed to make electric vehicles more affordable for less affluent people and to incentivize automakers to expand their customer base. Additionally, to get the full tax credit, the vehicle has to be assembled in North America. This provision aims to support domestic workers and businesses in the electric vehicle sector. However, this also means that many popular models from foreign automakers, such as Tesla, Volkswagen, Mercedes-Benz, and Audi, are disqualified from the tax credit unless they have factories in North America. Furthermore, the IRA offers an extra $2,500 bonus for vehicles that use batteries that are made in the U.S. with at least 50% domestic content. This bonus is intended to spur more investment and innovation in battery production and supply chains in the U.S. However, this also creates friction with foreign allies and global companies that rely on imported battery materials or components. To address this issue, the Biden administration has negotiated trade deals with Japan and the EU that allow some of their battery minerals to qualify for the U.S. tax credits. These deals are meant to ease trade tensions and foster cooperation on climate goals among major economies. Finally, the IRA imposes a price cap of $55,000 for sedans, $64,000 for vans, $69,000 for SUVs, and $74,000 for pickup trucks. This price cap is meant to prevent wealthy buyers from getting tax breaks for luxury vehicles that have little impact on reducing emissions. However, this also means that some high-end models from U.S. automakers, such as Ford's F-150 Lightning and GMC's Hummer EV, are ineligible for the tax credits unless they lower their prices. In summary, Biden's IRA provides consumer tax credits for electric vehicles and batteries that are made in the U.S. But these tax credits are subject to various conditions and limitations that affect both domestic and foreign players in the electric vehicle market. These tax credits are part of Biden's ambitious climate agenda that seeks to reduce greenhouse gas emissions and create jobs in clean energy industries. One of the most controversial aspects of Biden's Inflation Reduction Act, IRA, is how it raises taxes on corporations and wealthy investors to pay for its climate and drugs initiatives. In this section, we will explain how the IRA does that and what are the implications for the economy and the environment. The IRA imposes a 15% minimum tax on large companies that report more than $2 billion in profits but pay little or no federal income tax. This is aimed at preventing corporations from using loopholes and deductions to lower their effective tax rate below 15%. According to the White House, this measure will raise about $125 billion over 10 years and affect about 200 companies. The IRA also increases the top income tax rate to 39.6% for individuals earning more than $400,000 and married couples earning more than $450,000. This reverses the 2017 tax cut that lowered the top rate to 37%. The White House estimates that this change will generate about $170 billion over 10 years and affect less than 1% of taxpayers. Another way the IRA targets the wealthy is by closing loopholes for pass-through businesses and capital gains. Pass-through businesses are entities like partnerships, S-corporations, and sole proprietorships that do not pay corporate income tax but pass their profits to their owners who pay individual income tax. The IRA limits the amount of losses that pass-through owners can deduct from their non-business income, such as wages and dividends, to $250,000 for individuals and $500,000 for married couples. This is expected to raise about $125 billion over 10 years and affect about 400,000 taxpayers. Capital gains are profits from selling assets like stocks, bonds, or real estate. Currently, capital gains are taxed at a lower rate than ordinary income, ranging from 0% to 20% depending on the income level and the holding period of the asset. The IRA increases the capital gains tax rate to 25% for taxpayers earning more than $400,000 and eliminates the step-up in basis rule that allows heirs to inherit assets at their current market value without paying capital gains tax on the appreciation. The White House projects that these reforms will raise about $320 billion over 10 years and affect about 0.3% of taxpayers. The IRA's tax increases on corporations and wealthy investors are designed to fund its ambitious spending on climate change mitigation and adaptation, drug pricing reform, health care expansion, child care support, and other social programs. The White House claims that the IRA will not add to the federal deficit or debt over 10 years and will reduce inflation by boosting productivity and competitiveness. However, some critics argue that the IRA's tax hikes will discourage investment, innovation, and job creation, and will make U.S. businesses less competitive globally. Others question whether the IRA's spending will actually deliver the promised benefits for the environment and public health.